Very good evening to all of you. On behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountant of India, I welcome you all in today's 90th CP program organized by AASP of ICI this year. Today, this is the 90th CP program which we are organizing for the members. And today's topic of today's webinar is very important, that is audit evidence. In order to cater this audit evidence webinar, we are having with us very learned speaker, very learned from our Chartered Accountant fraternity, CA Vijay Maniarji. On behalf of AASP of ICI, I extend my warm welcome to Vijay sir. Welcome to you, sir, Vijay sir. Namaste. Welcome. Due to the pre-engagement in the some meeting, our Honorable Chairman sir and Honorable Vice Chairman sir are stuck up in the meeting. So, Vijay sir, if you permit, can we start?
Yes, we can start.
Yes. Vijay sir, as I have already shared, this is the 90th program organized by AASB this year, and more than 1,02,000 members have already gained knowledge from these webinars in these 90th webinars. And we have covered, sir, all the standards on auditing and all the aspects relating to the balance sheet, asset side, liability side, various audit consideration while auditing the asset side of the balance sheet, liability side of the balance sheet, all the standards on auditing. And now we are starting the sector-wise audit consideration, like audit consideration in the retail sector, audit consideration while the auditing automobile sector in the days to come, sir.
Great.
Yes, sir. Yes, sir.
Fantastic.
So I also welcome all the participants in today's 90th program organized by AASB of ICI. And it is my proud privilege to, with all of you, to share with the brief profile of our learned guest speaker, CA Vijay Maniarji. CA Vijay Maniarji is a fellow chartered accountant of Institute of Chartered Accountant of India and having over 35 years of professional vast experience. He was, since 1985 till 1999, he was associated with Maniar and Maniar, Chandrakant Mehta and Associates to set up the professional practice and created infrastructure over there. He was engaged with the entrepreneurs as a trusted advisor and sounding board and developed and mentored team to grow with them. And after that, in 1999 to 2021, he was associated with SR Bartley Boy and Company, and he was engaged with as engagement partner for statutory audit at large listed as well as the unlisted corporate, Indian, multinational, entrepreneurs, PE funded, including those which undertook capital market transactions. There was a sector focused retail, pharma and chemical, packaging, hospitality, manufacturing and retail estate. He was associated for extensive audit committee, board meeting experience, having attended more than 400 meetings and special invited to the Accounting Standard Board of Institute of Chartered Accountant for continuous 2 years. He was a member of Accounting and Auditing Committee for Bombay Chartered Accountant Society, Bakas, since more than 15 years. And he is a regular speaker at various forums of Institute at various chapters of the Institute of Chartered Accountant. He is a co-author of guidance notes on Division 1, 2, and 3 of Revised Schedule 3 of the Companies Act 2013 issued by ICAI. And is also the co-author of guidance note on Revised Schedule 6 to the Companies Act 1956 issued by ICAI and mandatory accounting standards extracted from the published accounts issued by Bombay Chartered Accountants Society. Now, since January 2022 until date, he is associated with AS and Associates, top 10 accounting and consulting firm of India. And he is associated as an advisor and mentor to guide the Mumbai branch operations and team, including the leadership team, to strengthen the practice. Still, list is very vast. So once again, I welcome you, sir, at this Zoom platform for the webinar organized by AASB of ICI. Welcome to you, sir. And without wasting much more time, I request to you, sir, to please start your deliberation on audit evidence. That is a very important aspect for auditing. Over to you, sir.
So thank you, Anilji. Thank you for your kind words of introduction. And I must really compliment the great work which AASB has been doing. Conducting 90, webinars is no joke. And, more than 1 lakh people, members have been benefited by, such programs. I think this is really commendable. And this is actually the need of the hour, when the profession is at the threshold. And a lot of discussions is around the auditors and the work which the auditors are doing. So I think this will significantly enhance the audit quality which all the members are delivering. Um, with this, opening remark, let me share my presentation.
Yes.
Yeah, once. Uh, is it visible?
Yes, sir. Yes, sir.
Okay. Friends, what I'm proposing to do, I think what I understand is almost all the auditing standards have been discussed, and now AASB is moving towards the sector based. What are the auditing challenges which we as members are facing? So I will try to, share, and this is what I've, covered in my presentation, as to, some of the practical aspects. Because, audit evidence, we have been studying and we've been doing it since the time we have started, studying and enrolled for the articleship. And even prior to that. But, as far as the audit is concerned, what are the practical challenges which we face day in and day out? What are the expectations? And how do we address those expectations by doing the quality audit? Is something which, I thought it appropriate, to share. So before that, let me, start with some, since you all have, gone through 90 webinars. Probably, this is a repetition, but I want to put, the context in which the audit evidence is, we need to gather the audit evidence. So first of all, let's start with, as I said, let's start with the basics. And the basic is that what is our objective? So our objective is to obtain, as audit, is to obtain a reasonable assurance whether the financial statements are free from material mistake. So important is it is a reasonable assurance. It is not a limited assurance. It is a reasonable assurance. And that it is free from material misstatement, whether due to fraud or error. So all our audit evidences, keep in mind, this is our talking about audit evidence. Other top, speakers would have discussed the similar this, but I'm talking from the audit evidence. Is whether the financial statements are free from material misstatement, whether it is due to fraud or error, and thereby we can express our opinion. And how do we do this? So there are all the auditing standards, which has been notified by the institute as well as NAFRA, and we need to comply with those standards. Couple of things which are important and which we will run through during my talk is, most important is it is our professional judgment. It is very, very important. We may be doing things day in and day out, but each audit, suppose if we are doing a limited review every quarter for a listed company, so each quarterly, each yearly audits, there is a professional judgment which is required. And this judgment, we need to be, mindful. It's not that, it's the first time we decide what is our professional judgment. Every time we sign off, we need to ensure that have we applied our professional judgment appropriately. So first is the professional judgment. Second is the professional skepticism. That also I'll deal with it. But I'm saying when we plan our audit, these two are very fundamental. Anything can happen, but nobody can take away our judgment. And we should be skeptical, during the course of our audit. What is our, what do we do? So we identify and assess the risk of material misstatement, whether due to fraud or error. So we need to find an audit evidence. Think about it. We need to find an audit evidence that what is and how and what are the risk of material misstatements. The next is important, and this is what we are going to discuss, is to obtain sufficient appropriate audit evidence. And we'll discuss all what is sufficient appropriate audit evidence, whether there is material misstatement exists through designing and implementing appropriate response to the accessories. So we identify the risk, we address that risk, and we form opinion on the financial statements. And if I were to graphically explain, and probably this is easier to grasp, what is our objective? If the same thing which little granular, it's not complete. How do we start the audit? Again, think about it as audit evidence. Is we first, as audit evidence, we understand the entity, right? How do we understand the entity? So we first understand the entity's environment. So which environment the entity? So is it, example, if I were to give, say, is it listed? Is it unlisted? The environment is different. If is it regulated? So if banks, insurance, say even telecom, is it a regulated environment? Where are the presence of the entity, and under what conditions they operate? So the whole environment of the entity. How is the board structure? How, what are the employee policies? So all those components of internal control, 5 components of internal control we evaluate, correct? All these we need to gather audit evidence. Correct. We are still into the gathering space of understanding the entity, understanding the business, which business is the. So suppose today we are auditing a company which has large, say, imports. Our focus will change to the exchange loss, right? Because there could be some imports and then that will be our focus areas. And then how do we gather evidence around, where represented the entity, the business, understanding the environment. Suppose it is a leveraged, entity. Then there will be a lot of stake and the say of the lenders. So what are the debt covenants, right? If companies expanding to different geographies, right? Understanding each geography becomes important. So idea is that gather the evidence in and around understanding the entity, understanding the intent, environment, understanding the business, and understanding this is all internal control. So 5, internal, will not go deeper into it, but how this entity's internal control, and this is the information gathering. Also there is the evidence, but information gathering. Based on this, identify and assess the risk, including risk of material mistake. Because we are issuing opinion on the financial statement, so we need to identify all the risks, right? And focus more on the risk of material mistake. So which are the risks where there, and I'll deal with, give some examples in and around this as to how do we identify and assess the risk, all the risks, including risk of material misstatement, whether it is due to fraud or it is due to errors. Fraud is intentional, error is not intentional. And this risk we need to identify at the financials, because we need to gather evidence, right? So we need to do it at the financial statement level, overall level, as well as at the assertion level. And also I'll deal with some examples about the assertions. So at assertion level, after considering this, we need to identify, we need to then design and implement our response to the assessed risk. Since we have identified what are the risks at the financial statements level, at the assertion level, now we will design and implement our auditing procedures, and we reduce the risk to the acceptably low level. It's a, what we are issuing is a true and fair opinion. We cannot reduce the risk to 0%. It has to be acceptably low level. And we need to understand, who are the stakeholders. So and what kind of on the reading of the financial statements. So we reduce the risk to acceptably low level. So that is our objective, and we need to gather evidence at each of the components. The next is, what is our audit risk? We've been discussing about the audit risk, risk of material misstatement. So now let's understand, have more persuasive evidence, higher quality of evidence if the risk is high. Our auditing procedure and audit evidence will change depending on the risk. Higher the risk, higher will be the persuasive evidence. Higher will be the samples, or no, or the amount of work which we do. We can live with little lower level of work if the risk is low. So then, because of this, since our attention has to go in towards the areas where the risks are higher, we need to identify which are the areas. And mind you, again, for each entity, each time we sign off, the risk could be different. Something could be industry specific, something could be regulatory, something could be unique to the company for that particular reporting. And that also we'll see, because idea is, as I said, first we need to identify the risk and then address that risk and obtain that audit evidence. And hence, it is very crucial for us to identify what is the risk. What I've tried to do and why I'm emphasizing for the sake of repetition is, this is very fundamental. So you might have done this, but in some other webinars, but I thought I will set down the context in which I'm going to speak, and hence I want to reiterate and reinforce this. So there are three kinds of risk which is there for each account. Uh, First is the inherent risk. Inherent risk is, it is posed by an error or omission in the financial statements due to factors other than the failure of internal control. Means it is the failure if there are no controls, for example, then is this account, is this assertion susceptible to risk? Let me give you a couple of examples. So if you are auditing bank, banks will do dealings in cash. Inherently, it's a higher risk item because bank is dealing in cash. So the inherent risk of dealing in cash, so cash account, it is higher. But whatever is the risk, each company, each businesses will control that risk, because, and that is where this is called a control risk, because control risk is addressing the inherent risk, how that risk is controlled, and it arises due to absence or failure of the operation of controls. So first is, if there are no controls, what is the risk? Second is, if the management and the would have instituted control, and what is the risk that arises due to absence or failure of operation, so that control is not effective. So that is the control risk. And the last is the detection risk. The detection risk is, even if both, somewhere something is not appropriate, but it is possible that we as auditors may miss it. So the third is the detection risk, which is at our end, that we as auditor may miss if some inherent risk is high and we have not considered, or some control risk is not effective, but we are considering it as effective. So our audit risk universe is comprising of inherent risk, control risk, and detection risk. Then how does it apply into the audit? That is where, and this is a little busy slide, so bear with me. I will explain to you. So this is axis is inherent risk, and this is control risk. Inherent risk can be low, can be high. We'll discuss significant risk later. So if inherent risk is low and the management has instituted control and we as auditors, we can rely on the control, then our risk is minimal. So the risk of that account is minimal. But if we cannot rely on the control, then that risk is moderate. Similarly, if inherent risk is high, that means, the account, the cash example which I gave you, if this is high, but we can rely on the control. So so inherent risk, so the total risk, the combined risk on the account is low. So here the low risk is minimal. So minimal means our risk is minimal, but low risk is it is higher than the minimum. So we need to do more procedures. We need to find more evidences around accounts which are low as compared to accounts which are minimal. Now, if we cannot rely on the control for that account, then if inherent risk is low, but we cannot rely, then we need to do more procedures than, if the risk is low. So I've categorized this as moderate. And the last one is if inherent risk is high and we cannot rely on the control, that means we need to do maximum procedure. So it's in the order of grading: minimal, low, moderate, high. Minimal, we can do minimal procedures. So we can gather minimal evidences around this. And high means we need to gather more persuasive evidence about this account. Significant risk is this if there are, by definition, significant risks are inherent risks with higher likelihood of occurrence and higher likelihood of material mistake. Let me give you some example to just drive home this, and hence we need to gather different higher level of evidence. For example, if the company has done any acquisition, there is a significant risk, because if it is an Ind AS entity, there is to be a fair valuation of assets, liabilities, consideration, correct, whether it is a goodwill, capital reserve, and the so on and so forth. So that year, that particular period, it is that acquisition of all this will fall into significant risk. Or for another example is if in a year company has changed its IT system, the whole gamut of controls testing within the IT system, there is a chance, because in the initial period controls may not be effective, and it is possible that there could be irregularities or the fraud, and hence in that period it is only that entity specific in that period specific where it becomes a significant risk. And last but not the least is the fraud risk. We need to identify and do the maximum procedures if there are any account which is identified as a fraud risk. And by design, or by default, uh, revenue is considered to be a fraud risk. So, revenue is the highest item in the financial statement. And I think all the stakeholders look at the revenues. If somebody were to say that I am a 500 crore company or 1,000 crore company, that means by and large, it's the turnover. And since it is so significant that all the stakeholders will look at the revenue, hence it is considered as a fraud risk. Of course, it is a default fraud risk. It is rebuttable assumption, and one can say that why this is not a fraud risk. But we are not getting into it. I'm just trying to say is my level of persuasive evidence will increase depending on the account. So let me give you, some of the account, and then, how it works. So cash and cash equivalent, what we discussed, inherent risk is high. We can rely on the control, so it is low, right? Inventory. For example, inventory. So this is the assumption. Inventory risk is high. I can rely on control, and and hence the risk of material misstatement is high. Why I am considering it is high? Because it is a very specialized inventory. Company amount value wise it is significant. I am, as we are as auditors, since it is specialized in inventory, uh, suppose we need to engage, the company has engaged some expert. Say for example, company has a large stock of coal, and the coal, how do you value, what is the quantity of coal? It is very difficult. It's a volumetric measurement which happens, right? So and then how much is the water content, what time, and what is calligraphic value of that coal, depends on what is the quantity of coal and then the rate. So if it is amount is significant, then even if I can say this is low, because the inherent risk is high and I can rely on control, but there is a high risk of material misstatement for other reasons, and hence we as auditors can classify this as high risk and accordingly obtain audit evidence. As I said, idea is to obtain audit evidence, more persuasive audit evidence. Similarly, share capital. Inherent risk is low, rely on control, minimal. However, in case say company has issues and startup, they issue lot many ESOPs, and if there are not proper control in and around issuance and exercise of options, one can say that we cannot rely on the control, and hence we will do higher procedures. Similarly, income and expenses. So this is what I thought. This is how account wise. But what we need to do, audit evidence is not only at an account level, but this is at an assertion level, right? And hence, for each and every item, we need to say that which assertion has the higher risk. So, for example, inventory. Let me take that example of coal. Now, if existence is a issue, so is so sorry. First of all, for balance sheet item, what are the assertions? Balance sheet item, the assertions are: is it asset or liability existing? Is it belong to the company, whether the rights or obligations? Is it complete? And what is the value at which it is stated? Is it as per the accounting framework? And last but not the least, presentation and disclosure. Mind you, we need to obtain evidence for each of the assertion, and our audit evidence will be different for each of the assertion. So inventory, as I was saying, say coal, the issue is about existence, right? Because for existence or completeness, we are dependent on the expert to say that what is the volumetric measurement, and this is the complete measurement. And hence, but say if the company has, and that is where existence or completeness will put it at a more or more persuasive audit evidence as against rights and obligations and valuation. So each of these exists, assertion, one has to say that what is the level of risk. Say for example, the company is a POCM company, right? So a percentage of completion method. Probably valuation becomes more important. So one is to then look at each and every item, caption items, each and every assertions, and then say that whether it is low, high, medium, minimal, or significant risk, fraud risk, and then the audit evidence to support that assertion will be dependent. Similarly, cash and bank, equity, capital, borrowing. The idea is that please be mindful, correct, is where is the risk? It is, it is not that we do same procedures, for all the accounts or at all the assertions. The crux is identifying the assertion where we need to have more persuasive evidence. And we can live with lesser auditing procedures where the risk is minimal. The same is the case for P&L items. So sale of goods and services. So I'm just, what are the assertions at P&L level? So as the sales occurred, so occurrence, so occurrence of that event. So has material been consumed, or has the cost been incurred, or is the expense incurred? So is this occurred? Completeness and classification. Is it all measurement? Specifically, sales have been measured, appropriately. If it is a, and that it has been recognized in the similar, same accounting period. The idea is that again, for each of these items, one is to evaluate for that client, for that year, or for that period, which of these assertions fall into which category of risk, and then accordingly obtain audit evidence. Even to identify that this risk, this line item and this assertion is at this risk, there is a procedure. So we'll test the control. So we gather the evidence. Again, that is the evidence gathering. So audit evidence is across the whole spectrum of our auditing procedures. It starts right from the beginning and ends, because each of the time we need to justify what we have done and why we have done. And all this needs to be documented. So with this background, I think for each, so let me go back to now we understand the standard of audit evidence. Now, keeping in mind that, risk of material misstatement, account assertion at account level, we need to obtain that audit evidence of our conclusion. The first and foremost is, and then if you say, we need to have sufficient appropriate audit evidence. And, we would have heard this about this term, sufficient appropriate audit evidence. And what does it mean? Sufficient means number. It is more of a number. Higher the risk, higher will be the number, right? So sufficient is the number of evidence. So for example, if we feel that this is a fraud risk item, we will do maximum sample, maximum evidence, so that becomes sufficient. But if it is minimal, we may take lesser samples, right? Our number of samples is dependent on what is the risk which is associated with the account. So it is a sufficient. The next is appropriate. Appropriate is whether what is the assertion which we are trying to. So if we are trying to see that is the company has understated the vendors, for example, then what will we do? Will we look at the invoices which has been recorded? Of course, we'll look at it, but our focus will be more about subsequent payments which has been done. And are there any vendors which we have paid after the period end and which is not accounted? Similar is the case for, say, litigation. We'll have to look at all the litigation which has occurred till the time we have signed off. Can we say these are the litigation list only up to the period end? And when we are signing it after 4 months, 5 months, that we will not look at any other litigation. Because if those litigations are giving indication of conditions existing as on the balance sheet date, we need to consider. So subsequent event becomes important. So what I'm saying is this appropriate under the circumstances? And we'll see some of the examples also as to, so our evidence, audit evidence should be sufficient, which is number. Second is appropriate. That means it is the quality of our evidence. The next is many times, uh, we start making inquiries, and then can we say that this inquiry is sufficient, appropriate? And this is what normally questions which clients also say, that you are repeating what has been asked earlier. So of course we'll ask, we'll understand, so we'll make inquiry. But only inquiry is not sufficient. Inquiry is to understand what is there, understand the process, understand that particular item, understand what has happened. Based on that inquiry, then we will depend, we'll evaluate, we'll do some procedures, and then come to conclusion that what is the risk of this account, where is the risk, and which assertion level there is a higher risk, and accordingly determine the auditing procedures. What is our source of audit evidence? First and foremost is we always leverage, right? And this very, I'm not saying, we do it. What has been our experience in the past? Next is, while we are doing audit, while we are, looking at the books of accounts and the supporting and the discussions and all things, whatever is we are doing, that is our source. Also, while we have accepted the account and decided that we will continue with this account, we do those procedures. Those procedures cannot be on a standalone basis. It has to be factored in while determining what is the audit risk. So for example, a lot of times we may may not know what is happening. Our face time is only with the accounts and finance team, but there could be something which is happening. A lot of times when we do Google search, or when we do background check, we get to know a lot many things. And nowadays there are so many agencies who will give us what is the background check about that particular account, right? That also helps us in determining what is a sufficient and appropriate audit evidence that we need to bring in. So if the company has got litigation, it is possible that this could be shared, but since it is outside the books, it is possible that company may have missed it. It could be deliberate, it could be error. But so long as through the background check we have gathered that information, has to be used while designing what is sufficient and appropriate audit evidence. Next is professional skepticism, and that should be all through the time while we are doing audit. It is, we should be skeptical. And this also creates a challenge as far as the client is concerned, because client will come back to us and say you don't trust us. So it's not the question of trusting. I think our response should be, since we trust you, right, we have accepted your audit, we have decided to continue with your audit after signing off. However, what we need is a evidence. It is one thing that we rely on what you say, but we always look at the evidence. Of course, there are some judgments, and judgments also we look at based on the management representations and discussions, but we evaluate whether those are reasonable. It is not that based on whatever management communicates, we will accept it at the face value. As I said, I'm repeating, we always need to have evidence of what uh, uh, management has said when it is available. Let me share you with you one example. And I'm saying this is, if we'll face some or the other way, you may also faced good client, correct, and the good accounting system, everything is well. And suddenly, when the company decides to change its accounting system, it is moving to ERP, right? When we get into the audit of this and we see so many errors, control lapses, it's a good management accepts our recommendations, and we design our audit procedures accordingly, and we sign off. Year 3, management says whatever you have done, we have corrected. So your efforts will be less, which is a fair point. We can take accept management, but unless we on our own test those controls, test that those IT loopholes have been corrected and controls can be considered as effective, we can't take it at the face value. And a lot of times you will see that though we need to educate the management. So representation is one thing, but based on the representation, we don't audit. We need evidence. And a lot of times when we look at the evidence, our audit risk conclusion may undergo change. So for example, if we are auditing a company and where we find that, say, the cutoff is not observed properly, right? Now, sales, as I said, sales is a fraud. By design, it's a fraud. We classify it as a fraud, specifically cutoff. If we get evidences to say that those sales of the subsequent period, even if it is, say, it is on the first or second, has been accounted in the previous month, previous quarter, previous year, that is something when we do audit, our risk on that cutoff will undergo a change. We will do more audit procedures. And if it is possible that there is a possible fraud, because there are some incentives which are linked to the sales, and hence the management has accounted sales of the subsequent period into the previous month. So what I'm saying is, as and we need to be constantly be skeptical. It's not that we don't, I'm repeating, it's not that we don't trust the management. However, we need to constantly be mindful is we need evidence. Our audit is evidence based. It is not based on the management representation. Of course, there are some judgments where we can rely, but we look at the reasonableness of the assumptions. One thing which always I've come across is, can we disregard past experiences? The management, we are very comfortable. Management is very sound. We don't have very much challenges, transparent, correct. All things considered, that is a past experience. We should consider this. But wherever the evidence is required, we need evidences. I'm very clear. I think, management representation is there. That is one thing. But the evidence, wherever possible, even if the past experience is good, right, we should be skeptical unless there is evidence. So our mind should be always saying that, though I'm taking it at the face value, do I have any evidence to support this or contradict this? And hence, a lot of times it is important that we change the team so that there is a new perspective which comes in, or that we change the familiarity, because if somebody is there on that audit with that client for long period of time, it is possible that there is a bias which comes in. there is people tend to leverage, and then we don't get the fresh perspective. So it is better to change the team, and that helps in ensuring that there is a quality audit which is done. Now let me share with you some of the examples just to drive home what constituted, because each, as I said, each audit, each year, same client may have a different, our audit evidence will undergo change. So I'm just trying to give some examples based on the annual reports as to what constituted sufficient audit evidence for, and this is all I'm talking about a key account, which are there. So this is about revenue recognition. It's a busy slide, but I'll say is that what is the audit evidence which the auditor thought it appropriate to conclude on the revenue. So one is revenue recognition fixed price contract. uh, uh, Important is here there is inherent risk and presumed fraud risk around accuracy and existence of revenue recognized, considering the customized and complex nature of these contracts and significant input from IT system. Right. So what I said is sales or is considered to be a fraud risk. This is what gets reinforced. What is the audit procedure which was done by the auditor? Is obtain an understanding of the system process controls implemented by the group for recording and computing revenue and associated contract assets, earned revenue and deferred revenue. Because it's a fixed price contract, correct? This is a unique, and that is where I've picked up. So first is for all the account. I'm just trying to start generalizing. Is we need to understand the process, system, and control, including involvement of our information technology specialists as required. Assess the IT environment. And think about it in your account. Are we doing it? Because this is one of the complex, one of the largest. But are we doing it similar? Because this, I thought these are all the sufficient appropriate audit evidence. And that is where I've picked up, few of them. So assess the IT environment in which the business system operates. IT is very, very integral, right, for the audit evidence. If we don't involve the IT experts, we do not know, because then it's a black box approach, which is not acceptable now. Nobody functions without IT. So IT expert is important, very, very important. So assess the IT environment. Tested IT controls over appropriateness of cost and revenue reports generated by the system. Tested controls pertaining to allocation of resources and budgeting system, which prevent the unauthorized recording changes to cost. Correct? Because it's a fixed price contract. So wherever the cost is incurred, it is debited to that account or contract, and accordingly revenue recognition is there. So cost going into the right account is something which is very critical. Tested on random sampling basis the controls relating to the estimation of contract cost required to complete the respective project, because it is considered on a cost to complete. So how much ever cost is incurred divided by total estimated cost, that determines the revenue. Hence it is important that what is my cost estimation is very, very important. Correct. Then on a on selected specific statistical samples, and that also we'll see, of contract we tested that revenue recognized is in accordance with the revenue recognition, because ultimately this has to be as per the accounting standard. Evaluated the identification of performance obligations and ascribed the transaction price. Correct. We also saw this, revenue recognition. If it is a multiple element contract, then how it works. For testing the group's computation of estimation of contract cost and onerous obligations, if any, we assess the estimates of cost to complete were reviewed and approved by appropriate designated management personnel. Perform a retrospective analysis of cost incurred with estimated cost to identify significant variations and challenge whether those variations are required to be considered in estimating the remaining cost to complete. Correct. This is again the base. If management says that my cost is X and the cost variation is on a regular basis, that means whether we can rely on the cost estimate, which is very fundamental. Because if my cost estimates are lower, my revenue recognition will be higher. It's very easy for, in the fixed price contract to, manipulate just by changing the cost, estimated cost. Assess the appropriateness of work in progress on the balance sheet date by evaluating the underlying documentation to identify possible changes in the estimated cost to complete the remaining performance obligation and inspected the underlying documents performance. I'm saying what happens in a fixed price contract. What is the, and this is, as I said, this is again for this account for this year. Depend the nature of business is, if it is fixed price contract, please ensure that you have this or some other companies, uh, that all the performance, what are the audit evidences one has to, gather to conclude that revenue is recognized appropriately. Let me, give you, that was a IT company. This is a manufacturing company, UPL. What procedures auditors did? We assess the compliance uh, compliance of the revenue recognition accounting policies against the requirements of India. So of course, we look at, correct, and we design our auditing procedure to ensure that, the recognition is there as per the relevant accounting standards. We evaluated the design and operating effectiveness of the relevant key financial controls with respect to revenue recognition on select. So both TCS as well as UPL, the effectiveness of, controls is very, very important. Using statistical sampling, we tested the terms of the revenue contracts against the recognition of revenue based on the underlying documentation and records, and evaluated accuracy and existence of revenue being recognized in the correct accounting period. See cutoff. So look at the contract. This is how we do it. Oh, I'm not saying, but I'm saying this is how sufficient appropriate audit evidence. This is a appropriate audit evidence. Sufficiency is dependent on the audit risk. We tested the arithmetical accuracy and existence of revenue recognized at the year end. On a sample basis, we evaluated revenue being recognized in the current accounting period. We assess the adequacy of disclosure in the standalone. So disclosure, one of this when we do audit evidence is the disclosure. So we should have the disclosure audit evidence that all the disclosures are in order. We should have the checklist. I think Institute is, I've been hearing they are preparing some checklist around all the disclosure standards, but this is very, very fundamental. We would have seen the annual report increasing in pages. A lot of disclosure requirements coming not only from accounting standard, but also from Companies Act or from SEBI requirement or other regulatory bodies. And hence the disclosure is becoming too onerous for this. And I've also taken one example later on this. The next is Hindustan Unilever. Now that was on sales. This is discount and rebate. It continues because discount rebate is also debited to sales, and hence it says that there is a risk being overstated. There is a risk of revenue being overstated due to fraud through manipulation of discounts and rebate accruals recognized, resulting from pressure the company may feel to achieve the performance targets as at the year. So everybody, as I said, I'm reinforcing, revenue by design is a fraud risk. One can justify why it is not a fraud risk and document, and accordingly audit evidence will undergo a change. So audit procedure, sufficient appropriate audit procedure, understand the process to determine accrual of discounts and rebate, evaluate the design and implementation and testing, operative effectiveness of the company's IT control. Again, IT control, all the places you'll get IT controls. Key manual and application controls over company's IT system, including controls over rebates, agreements, arrangements, rebate payments, settlements, and company's review of over rebate accruals. Because this is very subjective, it is party to party. So, this becomes a very subjective item. Inspecting on a sample basis key customer contracts based on the terms and conditions relating to discounts and rebates, assessing company's revenue recognition policies with reference to the requirements. So again, applicable accounting standards. Then one does substantive testing depending on what is the risk by selecting sample of discounts and rebate transactions recorded during the year as well as the period end and rebates accrual and matching the parameters used in the computation of relevant source documents. Examining historical rebate accruals together with our understanding of the current year development to form an expectation of the rebate accrual as at the year end and comparing this expectation against the actual rebate accrual, completing further inquiries and obtaining underlying documentation on a sample basis as appropriate. Very important. One looks at the past trend, but also looks at into the future, right? So suppose company may have estimated something in say December 19 quarter, and March, mid-March there was COVID. So March quarter things would have gone under completely. So it's not that one looks at the past, one also looks into the present condition and looks into the future and check the completeness and accuracy of the data used. Actualization of estimated accrual, because past, whenever there is actual estimated, how this has been actualized. Testing a selection of rebate accruals recorded after 31st of March and assessing whether accrual is recorded in the correct period, right? Same thing about overpayments, under accrual of vendors. As I said, this could also be under accrual, and hence subsequently how much rebate has been paid and whether subsequent payment is it linked to the accrual for this period and whether there is accrual, appropriate accrual is done. Testing a selection of payment made after 31st of March and where relevant, comparing the payment related to rebate accrual. And critically, assessing manual journal entries posted to the revenue. And this is very important. One more, audit evidence we should always do, specifically when there is a IT. In ERP system, certain accounts, if there are any manual entries which are passed, those needs to be very, very carefully looked at. Because, so for example, sales, if in ERP systems, the sales is always based on the system entries and there are no manual entries passed. But in the sales account, all manual entries needs to be checked. Similarly, if there is a purchase, all manual entries should be checked. In consumption, all manual entries, because if these are typical ERP system, these are all auto entries. And if there are anything which is there, one has to look at it closely. So again, one more item of sufficient appropriate audit evidence. UPL discount, I think this is all on a similar basis. So let me not repeat. ABFRL, because it has large, auditors have said why they've chosen this as an understood and evaluate, design and tested operating effect. All companies which generalize process controls, effective IT effectiveness, we have to do it. Evaluated periodic account reconciliation prepared by the management during the year. Evaluated management estimates and judgments in determining the provision for discounts and sales returns, and assess whether the same is consistent with the prior period. Evaluated the contract terms. I think we have said, verified the credit notes issued to customers on a sample basis and assess the validity of claims with underlying documents and appropriate approvals, and evaluated adequacy of disclosures made. So what I'm saying is these are all sufficient appropriate audit evidence for this key account, which is revenue. Are we ensuring that we have understood our from our client, from a revenue perspective, which are the assertions where we need to do more work. We need to leverage the kind of reporting which is done by the auditors to ensure that we don't miss. I'm not saying we need to copy that. I'm repeating, each company, each reporting, my audit procedures, our audit procedure could undergo a change. It's not, but we should ensure that we have done sufficient and appropriate. We have got audit evidence. This is on related party. This is important. This is a disclosure standard. As I said, disclosures are becoming too onerous, and hence I've picked up one for this. What it says is, we obtained understanding, evaluated the design and tested the operating effectiveness of the controls relating to capturing of related party transactions and management's process of ensuring all transactions and balances with related parties have been disclosed in the consolidated financial statements. Important identification. We obtained understanding of group policies and procedures in respect of evaluating arm's length pricing and approval process by the audit committee and the board of directors. Because all related party transactions get approved. We agreed the amounts disclosed with underlying documentation and read relevant agreements, evaluation of arm's length by the management on a sample basis as a part of our evaluation of the disclosure. We assess the management evaluation of the compliance with the regulations and the disclosure. The idea is it must be so important for the auditors of JSW that this disclosure is coming as a key audit matter. That means the amount and the complexity and the size of the related party transactions must be really complex. So related party transaction, I picked up few of them. The idea is that please ensure that these are normally hot topic items. Normally the items where stakeholders look at it, whether we are doing audit of listed companies or unlisted companies, because there are stakeholders. If it is a leverage company, then there are blenders. If it is a private equity, then private equity is there. Whether we have done adequate audit procedures, sufficient appropriate audit procedures. So once we saw something relating to sales discounts, which is all I thought was a fraud risk, then the disclosure related party transaction is something which is very, very important. We would have seen if there are some challenges on related party transactions or irregularities are found, suddenly the market price of that company goes down. So these are very hot topic. One hot topic which I picked up is going concern, and I thought it's very exhaustive, and hence let me discuss. So this is about the Tata Motors and JLR Group going concern. And this was reported by the component auditors, of JLR Group. So what audit procedure they did is auditor of the component considered whether this risk, there is a risk of, one was a global coronavirus pandemic, subsequently supply shortages, the increasing in price of key materials, correct, and how those risks might affect JLR's financial resources or ability to continue operations over the going concern period of assessment. So idea is that because of all these reasons, it must be so important that auditors thought it appropriate to bring it out in the key audit matters. So auditor of the component consider whether this risk could plausibly affect the liquidity or covenant, debt covenant. So if it is a leverage company, the debt covenant plays a very important role. Covenant compliance in the going concern period by assessing the director's sensitivities over the level of available financial resources and covenant threshold indicated by JLR Group's financial forecast, taking account of severe but plausible assessment of internal and external factors used to determine the severe but plausible downward scenario adopted and management's reverse stress test. So this is what ultimately one has to look into the future. So whether it is reasonable. So what I'm saying is we discuss any judgments and estimates. Are they reasonable? Funding assessment evaluated JLR Group's financing facilities to ensure that available terms and covenants associated with these facilities were completely and accurately reflected in cash flow forecast. Key dependency assessment evaluated whether the key assumptions underpinning the forecast cash flows which directors have used to support the going concern basis of preparation and to assess whether JLR Group can meet its financial commitments as they fall due were realistic, achievable, and consistent with the external environment and matters identified in the audit. The key assumptions include sales volume together with fixed and variable cost. So all the forecasting, financing array. Then you look at evaluated historical cash flow forecast accuracy. Past, again, one item what we discuss is whether past can be this of the future. So this is also evaluated. Historical cash flow forecast accuracy by JLR Group by comparing historical cash flow to actual results reported as well as assessing the accuracy of key assumptions previously applied. Because we have to be skeptical. That is what we discussed. Past is the base. And that base we can consider, and this is what rightly auditors have considered in this case. Benchmarking assumptions. Then assess the appropriateness of JLR Group's key assumptions used by cash flow forecast by benchmarking them to externally derived data with particular focus on sales volume. Sensitivity. Considers sensitivity over the key assumptions underlying to the cash flow forecast and their impact on level of resources. And then there is a disclosure. The idea is, it's a long and why I wanted to read and reaffirm, reiterate is, we need to be professionally skeptical, number one. We can rely on the management judgments and estimates. However, we need to conclude these are reasonable. It is not that, we take things at the face value. We need to see whether the data, whether internally generated or externally, these support the management conclusion. It's not that management document we can straight put it in the file. With this in mind, let us do some theory also. So what are the way in which we do this, obtain this audit evidence? So first is, and this is all we have done, but I thought, let me just for the completeness and refreshment, for refreshing, let's do it. So we need to first is inspect the documents. Again, we need to see whether that is the appropriate evidence. So when we say inspect the document, for example, if it is a title deed for a land, correct? That is it's a good way to look at it, but we need to also look at where are the origins, right? Because it's not the photocopy which is important, on which we can only rely. We need to look at, you know, appropriate is the origin. Also appropriate is what are the land related charges which we have paid, and the latest one from the regulatory authorities to conclude that the land continues to belong to us. Or for example, so this is a physical document, or 7 by 12, or whichever is the regulate, state level confirmation. But if it is a, say for example, fixed asset, right? Sorry, fixed deposit. Now, fixed deposit with the bank nowadays, you get electronic, you get the receipt. However, that can also be encashed. So unless there is a physical confirmation which is sent by the bank as on the cutoff date, the only that copy is not sufficient, right? Or for example, any intangible asset. One has to look at that. One can look at the existence of some intangible assets, but the ownership, it belongs to whom? So each of this, we need to say that each of these account, which is the appropriate audit evidence. So as I said, inspection could be good for land, but for fixed deposit, we need external confirmation, which is coming with. Or observation. We'll do, we'll observe. So for example, inventory verification, we observe how the management is doing inventory physical verification, right? But that observation has value only at that particular point of time. After that, what is being done, we do not. And hence, but that is one of the mandatory procedure of, observing how it is being done. External confirmation, most of the time, very, very important. Correct. However, care should be taken. If we get any confirmation from, say, generic email ID, so Hotmail, Gmail, we do not know whether that is the, the authorized person has signed. Even if we get not, from the right domain name, is that person authorized? But more so for Hotmail and Gmail, whether this has come from the company. In the other case, at least we know that this has come from the company, but whether that person is authorized. But in this case, whether the company has sent or somebody else has. So we should do the call-up procedures. So we should call back the party who has sent that confirmation, because it's not that all counterparty would have the domain name, and they may operate through Gmail and Hotmail. But is this coming from them? Are they authorized? And we should record that. That is the audit evidence. We should record that this is the day we called this number, this person, and he confirmed what, is there. So, or, external confirmation, we'll see. Recalculation is, if so, for example, company has done the depreciation calculation. So we recalculate. Correct. So it's a arithmetical accuracy we check. Or reperformance is, management may have, for example, some process and controls. We may run through that process to say that whether that controls are, effective, and whether it is being functioning or in the manner in which was being explained to us by the management. Analytical procedure is a subject by itself, but that's a very, very important procedure. And we analyze the data. Analysis could be financial data, non-financial data. So for example, in case of manufacturing, what is the consumption of raw material. And if it is a standard, then we can link it with the production. And is it appropriate? Because both sales and purchases rate may undergo a change. So we analyze, right, for margins. And you would have seen, most of the times all the analysts, they'll analyze what are the margins. The margins could be company specific. Suppose the company has suddenly huge margins or profit, but then we also look at and analyze whether the competitors. So look at and review the um, company's analyst report or competition report, whether the margins of the competition are similar. So I think this analytical procedure always helps in getting understanding, deeper understanding into the numbers and obtaining that as a part of audit evidence. And inquiry is we make inquiries. We don't, and say that, whatever audit evidence we have got, we start with inquiry. We may get some information from contradictory information from others. We make deeper inquiry into this, conclude what is the right one. But inquiry is a very, very fundamental procedures. One thing, for this, I would say our main face time is with accounting and finance team. But these inquiries we should with the respective team. So if somebody's, from sales and marketing team, we should have discussed sales with them. A lot of times management does not like it, but we should try to, have the face time with them. For example, if litigation is there, management may give us something in writing, but we should have that meeting with the compliance team and somebody who's responsible for the compliance to look at whether the list of litigations which we have got is complete, what is there, and so on and so forth. The next is about audit procedure is whenever, and I think we have discussed this, but we should always say what is this audit procedure which I am doing, is it relevant for the, so is it relevant everywhere? I'm reiterating, re-emphasizing what is the risk assessment of that assertion, which account it pertains to, correct, which item does it pertain to, and the relevant risk assertion, and accordingly is it relevant. The relevant assertions, if it addresses, that is our audit evidence we should capture. We should not try to do over audit, but we should definitely can't afford to do under audit. Correct. That is a big this, but I'm saying it has to be optimal. And the second is it reliable? Correct. Because I may have a relevant audit evidence, but is it reliable? From where have I got it? Professional skepticism. Is it, appropriate for me to, rely on this? And always we find that, which evidence is more relevant? Is it internal? Is it external? And this challenge always, we face. So this is external evidence. By design, it is more reliable. However, important is that party knowledgeable. Is this party knows in what context that evidence is being, given and taken. If the company has good internal controls, probably internal information and internal evidences are more reliable than external. So each company will have its nuances. Each item will have its nuances. It is our professional judgment to determine that which is the right audit evidence for this client, for this period, for this account, for this assertion. Now let's look at about management's expert, because a lot of times, for example, if there is any impairment analysis to be done, right? Actuarial is valuation. There are some complex securities, and we rely on the experts, going concern, right? Valuations. So I'm saying we rely on external, experts, and it's not. It is not expected that we are expert in that area, and hence we need to be mindful as to what kind of procedure one has to do whenever the management has engaged with an expert, because it is not that management is also expert in this, and that is where they have to rely on the expert to uh, uh, do proper accounting. So here this is for Grasim Industries: assessment of impairment of investment in subsidiary, associates, and joint ventures. And why auditors have thought it appropriate to bring it out? Because it says that the companies has investments of 21,000 crore plus. It's a significant item. So many investments, because there is investment in subsidiaries, associates, and joint venture. So what has management, auditors have done? Tested the design and operating effectiveness of internal controls over impairment assessment process, including assessment of valuation models used in assessment of impairment in the value. Again, this is constant even for this investment. What is the process, controls, and effectiveness of this? Examine company's assessment for indicators of impairment of such investments. In case where such indicators existed, tested the estimates and assumptions made by the company of the recoverable amounts and allowance for impairment for these investments. Assumptions is important, right? Evaluated the competence, capabilities, and independence of the specialist. This is very, very important, correct? That is the specialist who is doing the valuation. Is that person competent, technically competent? Correct. Is that person capable? Because many times somebody may be a valuer, but may be a valuer for, say, tangible assets, may not be valuer for intangible assets. Correct. Or and vice versa. So competence is one thing, capable, and the most important is the independent. It is not that for valuation, uh, uh, somebody has to be independent. Internally also valuation can be done, but if it is done externally by specialists, it is more persuasive evidence, because that person is independent. Management may not be able to influence, hence the independence of specialists. Involved our internal valuation expert to assist in evaluating the key assumptions of the valuation. So as I said, it is not that we as auditor are expected to be expert in reading these valuation reports, and hence we can also take help of experts. Tested arithmetical accuracy, assessment of historical forecasting accuracy by comparing previously forecasting. There also, Tata Motors also we saw historically what management has done. Is it, because this helps in ensuring that whatever is the management judgments and estimates which appear to be reasonable are achievable, because in the past management is achieved, and the disclosure. This is of JSW, and JSW has engaged management expert for capital expenditure in respect of PP&E and capital working force. This is also a hot topic item, additional CARO requirements. So I thought it appropriate to pick it up. Is why this is key is because significant amount incurred during the year. Judgments and estimates are required by management in assessing the assets meeting capitalization criteria, and judgments involved in determining the eligibility of cost, including borrowing cost and other attributes of the capitalization. So idea is that because of the size and the judgment, the auditors have thought it appropriate to bring it out. So we obtained understanding of the group's capitalization policy and assess the compliance with the relevant accounting standard. So process control compliance with accounting standard is given. I am not repeating. We have obtained componentization report issued by the third party management expert for capitalization carried out during the year and have assessed the appropriateness of the basis of componentization. We have also, as auditors, assessed the appropriateness of the basis and the estimate of. We are not expert in saying that what is the useful life, but based on the report, that is how it has been concluded. In relation to borrowing costs, we obtained supporting calculation, verified the inputs, and tested the arithmetical accuracy. We assess the accounting forecast incurred when the projects are suspended or delayed, correct? Including global pandemic. So accounting for cost incurred, because when there is anything which is in capital work in progress, this becomes very, very important. And we obtained understanding on management assessment relating to progress of projects and their intention to bring those assets to intended use. Very important. So as I said, management expert, competency, capability, and independence, and some or the some other items which I thought I've summarized based on this. I said internal versus external, whichever is better. I think external is better, provided they are expert, they are doing it, they are independent. Otherwise, internal, so long as company has proper internal controls over this. What is the risk of material misstatement of that item? If it is higher, then our audit evidence needs to be more persuasive. Availability of alternate source of audit evidence. Can we, one is the assumption, but is there any other alternative evidence which is available so that we can cross verify? I think competency, this we have seen. What is the scope of work? I think very important. External, internal, we may not have any engagement arrangement. This, but if it is external, what is the scope of work? That reading that we not tend to miss it. We only look at the report. Please look at what is the scope of work. Evaluate appropriateness as audit evidence for the relevant assertion. That is fine. If subjected to technical professional performance standards or other professional or industry, is that external expert, subjected to any regulatory requirement? If it is important, then and there is some consistency, there is some quality which can be expected. But if that external expert is not, there is no oversight of any industry or regulatory body, then the chances, I'm not saying conclude, but I think we need to be skeptical in this. Auditor's knowledge and experience of the expert. So if we have, has some experience about that expert, positive or negative, that is useful in concluding whether we can rely on the work. And we need to be mindful that, like us, they are independent and hence they don't have any self-interest. There is no familiarity, self-review or intimidation. So that it is very difficult. But I'm saying if we get to know this information, too much familiarity, self-review, threat, intimidation, that party is intimidated by the client, we need to be mindful of this. Coming to sampling, as I said, this is the sufficiency of auditing procedure. And there are three ways you all must be knowing, but I'm just trying to put it in, perspective. It is possible that we can do 100% of the item. When can we do it? Either the risk is very high, correct, or that the way the data is there, small items, similar kind of, items. So it is more easier, if we are doing some analytics, we are running some analytics and which are all new audit tools. it is, you pick up 100% of the data and analyze that data. And hence, that gives more assurance, not only to us, but also those charged with governance, say independent directors. So depending on this, all items can be done. Specific item. Many times we say, we'll look at, large value items or items about some cutoff. Rightly so, but there is no sampling. So scientifically, correct. So this is a judgmental way of we do it, but scientifically we may not be able to do if we do scientific sampling, where scientifically it says that it is more than 95% of the probability that we'll pick up, because in audit sampling we pick up smaller value items also. But this is our professional judgment, right? Management has no say. As per according to our assessment of risk assertion, we decide which is how much we should be doing. Coming to so that was about SA 500. Now SA 501 has given specific consideration to selected items, and SA 501 has given special consideration to, say, inventory, litigation, and the segment reporting. And we'll deal with it. Again, for inventory, I've picked up Titan report, because Titan, why I thought it appropriate, because it has jewelry. So again, specialized gold, diamond, and gemstone, which is very difficult for us. We are not expert, right? Then there is significant risk of loss of inventory given high value and nature of inventory involved. So what procedures, sufficient, appropriate audit procedure, which auditors have done? We evaluated the design, implementation, and tested the operating effectiveness of controls, which we have seen that the company has in relation to safeguarding and physical verification of inventories, including the appropriateness of company's standard operating procedures for conducting, recording, and reconciling physical verification of inventories and tested implementation. See, the nature of inventory is such, right? Normally, based on my understanding, the inventory physical count is taken every day, and gold. So all the purity is very important. And by look at it, one can't understand where, what is the purity of gold, what is the purity of, diamond. And hence this becomes a very specific item, and I thought it appropriate to pick up. Then we evaluated the design, implementation, and operating effectiveness of IT controls. Now imagine IT controls is also for all the most of the items what we saw, and key application controls over company's IT system, including those relating to recording of inventory quantities on occurrence of each of the sale transactions, including access control, control over program change, and interface between different systems. So complete IT change, is seen. For sample location, we attended physical verification stock conducted by the company and performed roll forward procedures as at the year end, where applicable. We also performed surprise stock count at the selected store. Correct. So there is element of surprise. Please think about it if you feel, because we should have some element of surprise for the auditing procedures. And roll forward, I think this also we'll see in one of the examples. And we also check this on a sample basis, reconciliation of inventory as for physical and inventory and the book records. And for samples selected using statistical sampling, we obtain independent confirmation of inventories held by third parties. This I thought was unique, and hence, so I'm saying, what do we need to be specific, for inventory? First is look at the risk of material misstatement for all items. What is important for inventory is it in existence? We saw this as an assertion. Then what is the condition of that inventory? Is that inventory good, expired, depending on the industry, right? So some items can last long, but it is not good. But some items like edible items or say pharma, There is a time period. So is it the condition? Can is there? And the count, so long we know whether the count, number of items is compliance with management's instructions. So management will give instructions. We as auditor need to read that instructions. Is it complete? Correct. That's our design we should look at. But if we are fine with the design, then whether that has been complied with by the management, by the those who are taking physical stock by them. Reliability of management count procedures. So even if management has got all the procedures, is this reliable? Because we are not present in all the quantity physical verification. So depending on this, can we rely on their procedures? What is the nature of inventory? Depends, right? So we saw in Titan, nature of inventory is different. Normally FMCG company, it is different. Pharma, it is different. In POCM company, it is different. So what is that? It depends on this. If there is work in progress, it is different. Location of inventory, where it is located. Correct. So we may not visit depending on cost benefit, but we need to ensure that the procedure is done. We can rely, and more so location. If it is a remote location, the inventory which is not moving, right? We should be more skeptical about it. So don't take things at the face value. If there is any inventory where location where we are not going, and the inventory is not moving, we should be more skeptical. Inventory with third party, what do? We take confirmation, right? Direct confirmation as far as possible. But there also, we need to be skeptical. So confirmation we may get, so we may go there and physically verify. And my experience is when we go there, physically verify that this could be different, correct? So we may not have accounted for shortage, or that job worker or some third party may have delivered the goods, but it is not accounted, or it is in a cutoff. So, there is in a cutoff. So they have shipped the goods, we have not received, or we have received, but it is double counted. So be mindful of the cutoff procedures. Inventory count other than at the reporting period. I think very, very important. We need to do roll forward procedures. And this became a, this becomes a very important, this, because it is possible that we don't, ideally we do stock count at the year end, but we may do at the other, other than the year end, again, depending on what is the audit risk. If it is a audit risk is less, we may do it at a different period and we do roll forward. But riskier item, we should do it at the year end. What if physical attendance is not possible? And very important point, and this is what we came across during COVID times, because all the physical verification which was planned at the year end, one could not do. The idea is, an institute came up with the guidance, but and globally all the institute came up with the guidance because of COVID. But everybody explained what is there in the auditing standard. So if physical count is not possible, then have somebody else doing the physical count on our behalf. Or because we need to be comfortable with the existence. So if that item is subsequently sold, that could be one of the way of complying. However, if a lot of things, all these things are not possible, we have no option but to put it in the report. And I put it in the report wherever there is, it was not possible for me to do physical count. I can be sympathetic, but professional skepticism says auditing standards not complied with. If depending on the materiality, either put it in the report, qualify, or do appropriately. But I'm saying that is how it is important. And last but not the least, for inventory, most important is the cutoff. Inventory items sold should not be considered as inventory. It should not be also considered as sales. But when we do physical count, we do not know the cutoff. So, and items which are in transit, how this is accounted is something which we should be met. So cutoff whenever the physical verification is done is very important, and we need to read that instructions which management is issuing for the purpose of physical verification. Litigation and claim, all this we were talking about was on the balance sheet in the accounts, but litigation and claims, it is possible they are not in the accounts. So what is important? Let's look at it. Risk of material misstatement, it goes without saying. How do we do it? Inquire with the management. Management may say one thing, but also in-house legal counsel, any compliance head, please look at it. And I would suggest, please take it in writing that these are the legal claims against the company. We are more important what is against the company. By the company, if any accounting is done, that is relevant. Otherwise, against the company is important. Uh, and if it is something which is, critical, review the minutes, review legal expenses. A lot of times you get, we get idea from the legal expenses why this legal firm lawyers were consulted. Review correspondence with external legal counsel. Because if company has engaged with external legal counsel, review the correspondence. If it is important and critical, obtain direct confirmation. Arrange meeting, because there are lot of times there are complexities, complex litigations, large amounts involved. Arrange meeting with the counsel. Of course, management should be present. We don't do it, outside the management, but arrange this. Involve internal experts. We are not like valuation. We are not expected to understand all the litigations. If we are not competent, arrange, internal experts. Obtain legal management reputation. And since it is outside the books, I have had some experiences of, when we ask for the direct confirmation, we get some claims or litigation which the management is not informed. So a lot of times we always take representation from the management about the completeness. One thing which I've learned every quarter is have meeting with the litigation, specifically where litigation team or the compliance team, specifically where there are large litigations, but nevertheless take it in writing that what are the litigations, run through that litigations. The idea is not only accounting, but some liabilities may also need to be disclosed as contingent liability, and which could be the huge amount. Again, here, JSW has reported about litigation because of the amount. And what JSW auditors have said, we obtained understanding, evaluated the design and tested operating effectiveness of controls related to identification, recognition, and measurement of provision for disputes, potential claims, litigations, and contingent liabilities. So idea is not only it is accounting, but also disclosure. We obtained details of legal and tax disputed matters and evaluation made by the management, and assess the management position through discussion on both probability of success in significant cases and magnitude of potential loss. We need to have, be mindful of this. Read read external legal opinions and other evidence to collaborate management's assessment of the risk profile in respect of legal claims. Involve tax specialists to assist us in evaluating tax positions taken by the management, and assessed relevant disclosures made in the financial statements. The idea is that have meeting, read the opinion, have meeting, involved internal experts, but also ensure that it's complete. Similarly, Grasim, there is a litigation, and this matters relating to direct tax and competition commission. It is similar. Here also involve tax expert in assessing the nature. I'm saying don't be hesitant. We need not be expert in all this. Please involve experts whenever we feel that there is a need, because its consequences could be humongous depending on facts and circumstances of each case. Tata Steel, lot many litigations, correct? Here one thing which I wanted to read is same thing is there. It says status of material litigations which were reviewed and noted by audit committee. Because if any committees we should are looking at the litigations, we should look at it. Then external expert specialist opinion. Now this is important. We evaluated the management's assessment around those matters that are not disclosed or not considered as contingent liability, as the probability of material outflow is considered to be remote by the management. So it is not. So this is where I thought Tata Steel I should put. So any litigation, we need to analyze and be comfortable. It is possible, probable, remote. Right? Possible is, the litigation is there and it can be disclosed. We are comfortable. It is not provided. Probable means it needs to be provided. But remote possibility is, even if there is a litigation, we are comfortable this is a frivolous claim and it need not be disclosed. And that is something which we as auditors should be comfortable, because if management says, in management, any order which comes, management will say this is frivolous. But unless we are comfortable, this is a matter for the audit report. The last item which is there is on segment information. This is also disclosure requirement. Now, analysts and stakeholders not only look at the financial results and the statements, but they also look at the segment information. And hence it is critical, and rightly so, that has been emphasized by the auditing standard. So, we need to understand, because it gets disclosed, is the method which is used by the management, is how the segments are being disclosed, right? In India and overseas, lot of times, after this management review of the segment, correct, how management reviews that segment, they've changed the disclosure. Even after Ind AS coming in, if either the companies have looked at segments differently than earlier one, or that the companies have started disclosing segment the way chief operating decision maker is looking at the segment. So we should be comfortable with the way these disclosures are being made. It is, though companies would want to show it minimal, segmental disclosure, but it is also our responsibility to see that we are comfortable with what has been disclosed. This is how the chief operating decision maker is reviewing for the review of performance and the allocation of resources, how the MIS is work. We need not go deep down into minutely, but at level at which segment information uh, they are looking at it, we should look at it, and we should ensure that it is in compliance with the relevant accounting standard, be it Indian GAAP or Ind AS. So that's it from my side. Hope I have been able to, you know, communicate my thoughts on audit evidence, and said, I thought, as I said, with some practical aspects around this. But if there are any questions, I would be happy to take those questions.
Thank you so much, sir. Can you hear me, sir?
Yes, yes.
Thank you so much, sir, for such a detailed and wonderful deliberation, sir. I have received certain queries from the members.
Sure.
One very general query from the member, sir. If we talk about the audit documentation, so what is the basic difference or relationship between the audit documentation and audit evidence, sir?
So whatever is the audit evidence, what we gather, correct, that needs to be documented. So one is
Yes.
audit evidence is we look at it, correct. But the basis on which we have concluded is something which, so for example, I mentioned about say land records, right? So we have looked at the original, title deeds or the latest, land records or something, correct? But then we should document this is what we have seen, and whatever is the copies which are possible, we should take on the file, because that is what we can say that this is what we have seen and this is the support. So and what is our conclusion? So for all the evidences, so it's starting with saying that why am I considering this item as the risk or risk of material misstatement, to saying that since this is the risk of material misstatement, what is the auditing procedure which I've decided to do, what procedures I actually did, what was the observation, are there any issues, what issues arose, how those were disclosed, and what is my conclusion. My documentation will support the audit evidence. Audit evidence
Yes.
is a very important aspect of this, but only audit evidence will not support. As I said, the documentation should be that an experienced auditor, by looking at the documentation, will come to the same conclusion as the auditor, herself.
Yes.
So that is the level of documentation. So audit evidence is a very important this, but unless it is documented in this manner, this will not have any value. So I may have only the photocopy of the land documents, but what procedures I did around this, that will not be visible. So that has to be documented.
Ji, sir. Sir, can we use the audio evidences like recordings, etc., as a audit evidence, or
Yeah.
if yes, up to what extent?
I have not used it, frankly. There is a IT Act around this, but audio evidence, somebody can do the voice modulation. So audit evidence can help us in this audio evidence can help us in being skeptical, skepticism. But unless there is a something in writing, would be difficult. I've never used it. I would support or contradict the management assertion by documenting it. But as an evidence, I have not used it. So if it is contradictory, then I need to, change my, audit evidence, what I'm looking at it by saying you contradicted this. Or if it
Yes, sir.
supports, then I can document this. Okay, this is what I concluded, and this also supports, and take it in the management reputation. But audio is something which
So, what are your suggestions or your guidance about the documentary evidence for compliance of other laws?
understanding of the entity, right, and the environment, and what are the rules and regulations, because that becomes very critical. As I said, if it is a listed company, then SEBI regulations becomes so important. If it is a banks or NBFC or insurance company, the IRDA and the NBFC and RBI regulations become so important. So what are the key? Because if you don't comply this, there is a large consequences around this, including going concern. So
Yes.
understanding of those laws and regulations, and there is a new standard also which has come in, but understanding them, and what are the financial implications where, right. So if there is something which is environment related, it could have huge consequences. So understanding, evaluating, and then accordingly where is the audit risk, which assertion, that we need to figure out. As I said, we need to put it in this, assertion. What am I looking at it? What assertion? We don't do anything beyond assertions.
जी sir, जी sir. So how can auditor reduce the risk to an acceptable level?
This is by
If you
doing
could,
all, sorry.
one member is seeking your expert guidance. How
uh,
can the auditor reduce risk to an acceptable level?
so, as I said, by following this process of chart which I explained, right? As to, because we are not issuing opinion, it is not expected, it is true and correct. So we always have the concept of materiality, right? We look at what is the expectation of the stakeholder. Idea is that any stakeholder, correct? So any decision maker will change the economic decision based on the reading of the report. And the concept is that the stakeholder understands that these financial statements are being prepared under this, understands the financial statement. So reading of the financial statements, understands that there are judgments which are involved, understands that this is prepared on the materiality basis, right? And
Yes, sir.
so it is a knowledgeable, that is, to, so that is the starting point. And then based on the our identification of the risk of material misstatement, whether we have identified that risk appropriately. So that risk will be a combination of the company timing and extent of auditing procedure. That is the way we can reduce it. We can't completely eliminate. It's a cost benefit one is to.
Yes. Sir, last question. Sir, how many years we have to preserve the audit evidence, sir?
I think it is SQC 1, which is about, I think, 8 years is there.
Ji, sir. Ji, sir. Sir, thank you so much, sir. Now we come to an end. It was wonderful deliberation and whole 2 hours you have spoken solely without any break, sir. And you have covered all the aspects of both these standards, sir. Thank you so much, sir. On behalf of AASB of ICI, I extend my heartiest thanks towards you, sir. Thank you so much,
Thank
sir,
you.
and wish you a very, very happy festive season and happy Diwali, sir. Happy
Yeah,
Diwali.
yeah. So that wish you and all the participants a very festive Diwali after 2 years, and hope we all are able to celebrate and catch up those past 2 years which has been lost. Thank you
Yes,
very much.
yes, yes,
Thank you.
yes.
Thank you.
Thank you so much, sir. Happy
Thank,
Diwali to all the
thank,
participants also.
thank
Thank you so much.
you.
Namaste. Namaste.